So here's an example of, let's say if we were using some sort of fundamental analysis and we were looking towards Ethereum's EIP 1559 update. And this scenario can be applicable to other fundamental updates that can happen to other coins. On the long term, we're looking towards Ethereum's merger with its consensus layer, right, which previously was called Ethereum 2.0. So a future situation could occur where something like this happens again. We'll have to see, and we'll have to see how true and how similar they will be. But this is just an example. So let's say you mainly held Bitcoin in your account, and you saw that Ethereum was going to release a major protocol update on August 4th. You could have swapped your Bitcoin into ETH using a ETH to Bitcoin trading pair to take part in the potential increases that ETH would see in the week leading up to the update, the day of the update, and the following days after the update. Typically, when we're looking towards fundamental increases or fundamental changes in a project and the typical price valuation increases or fluctuations as a result of the update, we can kind of break it down into three parts. The time leading up to the update, the actual update itself, the day of the update or the hour of the update, and then the following days of the update. So we could section this off into three parts. Maybe typically we can make the most from the pump leading up to the update. The day of the update, sometimes they fizzle out, right? And sometimes if the day of the update fizzles, we usually will see the following days fizzle out as well, maybe some sort of dump, or the market bottoms out and then continues on and produces some sort of recovery. This really depends on coin to coin, market sentiment, and overall usage, and general speculation as well. But typically it's best to use these as a buy the rumor and then sell the news the day of the update. That way you can secure profits and secure any sort of potential increases in valuation on the run-up of these fundamental updates. Now, the following charts are going to display Bitcoin and price action from August 1st to August 7th. Where we saw from August 1st to August 7th, Bitcoin saw a 13.50% increase. Generally, Bitcoin was on an uptrend. It was increasing. August 1st to August 7th, Ethereum saw a 26.37% increase. Almost double, nearly double the increase that Bitcoin saw. So during this time, we knew that there was a major protocol update, EIP 1559, highly controversial, mainstream news. Even CNBC, Yahoo Finance was talking about it. It was headlines, was on Forbes. People were talking about Ethereum. A lot of hype around this update. Bitcoin at the same time, late July, we reverse out of the downtrend for the past 3 months. We're starting to shift the market structure to an upwards motion. There's a major update coming into Ethereum as well. You could have potentially shifted your Bitcoin, traded your Bitcoin into Ethereum, rode up that percentage increase, and then swapped back into Bitcoin. Here's an example. This is what this looks like on the charts. So here we see from the 1st to the 7th, Bitcoin increased 13.5%, right? We started around here, and we actually came down a bit and then recovered and came back up and produced a higher high compared to the previous high observed in late July. During the same time period, while Bitcoin produced 3 or 4 days of consecutive red candles and eventually bouncing and continuing upwards, Ethereum produced a green candle, went up in value, came down, And we could arguably say it came down lower than our entry, but ultimately closed at our entry, at where we shifted into, and then continued upward for the next 4 days, producing an even higher upthrust compared to what Bitcoin did. And this is where we see the bulk of this 26.37% move to the upside. Now, there are considerable limitations and downsides that we want to make note of when trading crypto trading pairs, crypto to crypto trading pairs. Not all currencies are interchangeable. This is one of the big ones. Exchangers will often only offer a selection of crypto to crypto trading pairs, meaning that not every currency can be exchanged with just any coin. We also want to account for volatility. Crypto pair trading is considered high risk due to the volatility of the cryptocurrency space. Pair trading can be dependent on theoretical changes such as correlations, statistics, probability, price history, but there are no guarantees that the price of a coin will move in a set direction. There are no guarantees. Anybody that tells you what something will do is just lying, because the reality is nobody knows exactly what will happen. There's also the length of the investment. Crypto pair trading is not a strategy that produces immediate results. It's not something that you can swap your Bitcoin into ETH and then swap it right back within an hour and make $1,000. Volatility in the market may produce different results in different time frames, right? Typically, this is something that we may want to consider for a longer period of time, maybe several hours, grouping of hours, days, possibly even weeks. There is no guarantee that the price of the coin you are trading into will go up in the time frame you are expecting. Now, could you do some sort of trading strategy between cryptos on maybe through a more scalping mindset? Maybe you're looking at the 5-minute or the 15-minute and you're looking to make these several trades between cryptos and capitalize on small price fluctuations. Sure, you can. Would I suggest that? No, because it's considerably more volatile and considerably more risky, especially if you are constantly trading back and forth between them. You may not even be able to break profit or break even because of the trading fees, right? So there's numerous things we want to consider if we're trying to formulate a strategy based on pair-to-pair trading. We also want to consider liquidity. We want to consider the liquidity of the trading pair and the exchange listed. If the pair has low liquidity or low volume, it may take longer to fill the requested order. Consider value as well. If you're using a crypto to crypto trading pair, make sure that you're not losing value from the conversion. If the crypto that you're trading into is losing value, you will lose value of the coin you originally had. If you trade into a coin, let's say you had XRP to Bitcoin, and you trade your XRP into Bitcoin, and Bitcoin is dumping and having a bad day or bad week, you will be losing value of that account. And even if you trade back into XRP, you will, as a result, have a lower amount of XRP than you did before because Bitcoin was going down. Now, experienced traders can determine pairs that once exchanged, their capital will raise in value. And that's really the trick behind trading pairs, right? We're moving coins and moving value, not even just coins, but we're moving value between coins, interchanging them as we ride their fluctuations. And as a result, the idea is to increase said value of our account over time because we're riding these fluctuations between coins. Now, for example, let's say you were going to use an Ethereum to Bitcoin trading pair and you wanted to move your ETH into Bitcoin. You could track Bitcoin's price patterns and swap your ETH into Bitcoin to increase your investment's value when Bitcoin pumps or when Bitcoin bottoms out, you swap into Bitcoin and you ride that wave back upwards, right? And remember, regardless if we are an uptrend or in a downtrend, regardless of the market, there's always price fluctuations. Price will go up and down. The general direction might be in a certain path, right? Either downwards or upwards, but there's lots of valleys and hills, and sometimes we might be at a standstill. With something like this, the idea is we are swapping into the currency when it's we're swapping into the currency when they are not necessarily aligned. So let's say this is Bitcoin and maybe this is Ethereum. And not all the time when Bitcoin is at that high point, Ethereum is at that high point. Sometimes Ethereum is at the low point. So let's say Ethereum reached some sort of high. Bitcoin is at some sort of low of its value, of its peak, of its valley, right? You could swap your Ethereum when it's at a high point. You're going to swap it into Bitcoin when it's at a low point. You could track Bitcoin's price patterns, identify, it looks like it's going to continue the pattern and then swing back upwards. You could ride that swing upwards, and then once it reaches some sort of high point, or really taking profits is up to you, you swap your newly increased Bitcoin back into Ethereum, and as a result, you will end up with more Ethereum than what you had.